In the era of cheap money, everyone thinks they are a financial genius. Buy anything. Every property increases in price, and the market is like an escalator. Take investors to the top without a step. But when the music stops, the AI has a seat. We're entering a new phase. High interest rates are no longer temporary. That can become the next normal state. The money is full. ATM now closed, and each type of property from real estate stocks to digital money and silver dollars, they begin to reveal their true weaknesses. If you are holding an investment property or just fiddling with the math, what kind of money do you keep? Then this video is for you. We're going to take a look at 5 common asset classes. The best way to understand when money is not easy, what will keep the value, and what can fall free. And maybe just a small adjustment from today help you not to be the last. Leave the party when the glass of wine is empty and the bills begin to come out. But before we get into the details, to each type of property, there is a risk of collapse in the current period. There's a core rule that any AI needs to understand. It's a simple but powerful principle. Property prices always move by cash flow. When money is cheap, interest rates are low, easy access to credit, investors are willing to borrow to pour money into the property. They boldly buy house, buy shares, hugging coin, because of the risk has been clouded by the abundance of cash flow. Short-term profits make them feel confident. It's even invincible. But when money becomes more expensive, interest rates rise, credit is tightened, everything changes. Capital costs rise, psychologically afraid to return. Cash flows immediately retreat, and as a result, asset prices. It's not just a theory in a textbook. That's the loop. Has been repeated many times in the history of world finance. It's hard to stay awake. When everyone is around, they're all raising a toast to the profits. But imagine you're attending a luxury wine party. Melodious music, dim lights. The wine is always full of excitement. Everyone thinks this game will last. Until the wine pitcher quietly disappears. Lights on, music stops playing. And those who are drunk, they are the most disoriented. The story on the property market, it's the same. When money is plentiful, they all look like investment geniuses. But when the taps are locked, only they are conscious and have a plan, not caught up in the storm of chaos. It's like a domino effect. When a ball falls, the whole chain started to collapse. Inflation goes up. Decision to raise interest rates from the central bank. Yuan. Higher interest rates lead to higher borrowing costs. Reduces purchasing power. Borrowers are under pressure to repay debts and sell their property. The bear market created panic, and then trigger the next wave of selling off. It just takes the first piece of the puzzle to go wrong. The whole system can wobble. So, whether the property or holding holds value, if the money is not as cheap as before, a house that has doubled in value, thanks to the easy money phase, but it can be sold when the mortgage rate goes up to 8%. A stock that used to fly high in the midst of market excitement, is it still attractive when the investor withdraws capital? The amount increased 10 times in 2 months. Can you keep it? Trust when people start to get scared? Those are not easy questions to answer, but it's got to be laid out, and as soon as possible. Because the worst thing is not the price drops, it's not reacting when it's too late. We will analyze together each property in the next section, from real estate, securities to crypto, gold, and USD, to see clearly. When the music stops playing, there will be a seat to sit on. And then I will be the one who gets knocked out of the game. Being prepared doesn't help you avoid the storm, but it gives you a thick raincoat, so as not to get drenched in panic. The first type of property, real estate. The first victim of expensive money. In the years when cheap money flooded the market, real estate is almost the pet of Vietnamese investors. Buy is win. I owns land, owns houses. I feel like I have gold in my hand. It's not only safe, it's becoming more profitable. But that's when the money comes in like spring water. In fact, real estate is not a superhero, immune to macro fluctuations. On the contrary, this is the most dependent property. Into the loan. He was also the first victim when interest rates rose. Imagine this: you want to buy apartment worth be $1 billion VND. Bank loans are only 6% per year. The amount of interest you have to pay monthly is relatively easy to breathe. But if the interest rate goes up 10%, every month you have to spend millions more just to pay interest, not to mention the original. With many people, it's not an investment anymore, it's a burden. It's not just theory. In the US at 2-10 and 202-1, mortgage rate is only about 3%, the golden age of the housing market. But when you go to 202BA, the interest rate jumps to 6-8%. The consequences come so quickly that it's mind-boggling. In just 6 months, housing transactions drop by 40-50%. Many projects have to lower the promotional price for internal gifts 7. They even sell at a loss and still have customers. Vietnam is no exception. The resorts that used to be so popular, promotion lifetime profitability, there are no buyers now. Abandoned project, overgrown grass. The secondary investor can't get out of the capital trap. While bank interest rates are steady, knocking on the door every month. But the problem isn't just high borrowing costs. It's worth talking about. It's the liquidity of real estate. You can sell stock in seconds. Sell one coin in minutes. To sell an apartment, it usually takes weeks, even every month. Not to mention you have to negotiate a lower price, do the paperwork again, and pray to God to meet the buyer. And it's because of that slowness, many investors easily fall into a negative spiral. Buy when excited, loans when interest rates are low. But then the market witnessed a weak rent. Interest rate hike craft. They fall into a rock-hugging state and can't escape. An often overlooked risk opportunity cost. When you bury billions of dollars into an illiquid asset, you can miss a lot of other opportunities. Opportunities come quickly and need cash to seize. Keep your property when the market moves. It's like keeping a safe without a key. It looks good, but can't be used when needed. Of course, not every property is bad. Assets that are really valuable, for example, housing in the center, have stable rental cash flow, or residential land in the right location with clear planning, there will still be some resistance, but that's a small number. The majority of transactions by movement, by rumor or by word. There's going to be a North Bridge. The metro will come here. Is revealing its fragile nature. Surf-style investment apartments. Expect to sell again quickly to make a difference. It's turning into debt with each new interest rate announcement from the bank. And fortunately, many people still believe real estate never goes down. But reality proves the opposite. The price is not falling, but also quietly and persistently reduced because it can't be reflected in the day like a stock board. It's down from fewer calls, from unanswered messages, from semi-urgent sign-hanging projects without AI hungry forever. Perhaps the most important thing to remember right now is the true value of real estate. It's not in the advertising numbers, it's the actual rent. The real needs of the people. User interface. Buy because you think the price will always go up. You may be holding an item like a stone covered in gold. Look out in the light. But it's heavy and hard to exchange for real value. When the market changes, the investor is sober. Don't just look at the profit potential, but also the possibility of escape, the carrying capacity of money and sustainable value behind every square meter of land. Because if you keep the wrong thing in this tumultuous time, maybe you didn't just lose the opportunity. It takes time, patience, and financial freedom that you've worked so hard to build. Second, asset class securities. The most sensitive ball to the psyche. If real estate is an elephant, it's going backwards when money is squeezed. Then the stock is like a flock of sensitive sawbirds. It's very fast and can fly around, just because of a small noise. That's why SAO. Of the types of property affected when the cash flows out, the stock market is always the first and fastest channel of collapse. The stock market doesn't just operate on data, it's mostly run by emotions. Every candle on the graph is a heartbeat. And every time there's bad news, my heart is beating. A company reporting a loss, a bank raising interest rates, a billionaire on the internet. That's enough to create an effect. Breadboard like blood. Millions of mouse pointers simultaneously plunge into the sell button. So yesterday's green numbers, it suddenly becomes a distant memory. We've seen this very clearly before. Like the dot-com bubble of 2000. Hundreds of internet companies, valued in the sky. There's a .com in the name. Stock price soared. Free fall in just a few months. By millions of dollars. And hundreds of thousands of retail investor accounts. Or like financial crisis to number 8. Just a name, Lehman Brothers crumbled. It's Wall Street. Traction following the global sell-off wave. And this isn't just happening in America. There are trading sessions in Vietnam that the accounts of thousands of people evaporated 340% value after just 1 week. Many investors don't understand what's going on, just staring at the electric board. Then panic action follow the crowd. Have you ever bought a stock? Just because I saw that AI on the internet saying this one's about to fly. And if you've ever wondered, how is this business actually doing? Or just care? How many percent has it increased in the last 2 weeks? And we're often confused in the stock market. It's between cheap and value. A stock that fell from 40,000 to 8,000. It doesn't mean you're buying. Because if it's a dying business, no more cash flow, no more competitive products, 8,000 is too expensive. You're going to hold assets that no eye wants to touch, even with a 50% reduction. But for an equally dangerous reason, is to believe the rumors or hot recommendations from social networking groups, instead of reading and understanding financial statements yourself. Stocks are not fast food. You can't just look at a few lines and make a command. It's part of the business. And you need to know that the business is doing well or is crumbling. So don't buy stocks just because they're cheap. Buy because you know the company, believe in its ability to survive a crisis, and are willing to hold on long term even when the market shakes. Winners in the stock market. Not a fast man. It's someone who knows what they're holding. And if the market drops 10% tomorrow, do you know which stocks to sell? And hold any shares? If the answer is not sure, maybe you're investing in hope, not by understanding. And in a market that's as volatile as it is right now, I hope it's not a strategy. Be asset class crypto. The land of dreams turns into a nightmare. If the financial markets were an amusement park, the crypto world is a roller coaster. Colorful extreme stimulation. It's very attractive, but it's also risky. And the scariest thing is not that the ship is going downhill. It's a lot of people who go up and forget to put their seat belts on. Let's go back to the golden age of crypto, about year 2010 to early 2022. Bitcoin rises from $4,000 to over $60,000. Ethereum went from a few $100s to a few $1,000s. Everything related to blockchain tokens. NFT becomes a goldmine. People who didn't know anything about technology now also talk metaverse to fight cold wallet, hot wallet. I also believe I am living in the midst of a global financial revolution. Remember the play-to-earn projects that used to rain the wind? Coins of unknown origin suddenly multiply by 100 by 300 after just a few weeks. NFT of a simple cat drawing photo, bought for the price of an apartment. This fever makes many people really believe that I've found a shortcut to financial freedom. But then the binge of money ended soberly. 2020 to 2020. The crypto market is closed. Bitcoin drops more than 70%. Many altcoins have lost 90 to 95% of their value. Tokens that were once sought after, no one is asking to buy them. All of these exchanges are referred to as banyan trees, as FTX also in turn went bankrupt. Traction by millions of white-handed investors. Here's the obvious difference. Crypto and other assets, like real estate or securities, there is no physical property behind it. You can't see the headquarters of a coin. There is no production line running behind a token. Its value exists based on trust and cash flow. And these two things are incredibly fragile. Just a negative tweet a floor has trouble. An influential figure suddenly turns the car on, is enough to trigger the chain sell-off effect. And the scary thing is that in the crypto world, everything happens in minutes, not weeks or months. Just like traditional markets. One-click sale, enough to cause the price of the coin to evaporate like a sponge. You may think, but there are winners. There really is a big winner. But most of the winners, those are the people who got in early and escaped at the right time. The rest of us just find that we're late. I'm late, and I have a digital wallet. That the value is no longer the original dream. And this is what you need to remember the most. Crypto is the most attractive place, but also the most dangerous. It opens up 10 to 100 times more wealth multiplication opportunities, but you can also erase what you have in just one night. So do you really understand what you're investing in? Or just running along with the crowd in the hope that it will rise again? It's because people buy it because it's cheap. Or worse, for fun. Congratulations, you're playing a game of chance, not an investment. The best thing with crypto, maybe just think of it as a small part in your investment portfolio. A part of you is willing to lose. Don't put the future in a market. It's still too new, too volatile, and there's no solid legal framework to protect you. And if you're on a crypto roller coaster, at least make sure you're wearing your seatbelt. Never forget the stop-loss button, both in the app and in psychology. The fourth property, gold assets holding prices or illusion of shelter. Every time the market moves, many people say a familiar thing. Buy gold for sure. It seems to many Vietnamese, gold is not just a precious metal, it's a psychological symbol, a spiritual refuge. Every time things go wrong around you. It's actually understandable, since the golden grandparents were present in the rice jar, at the bottom of the cabinet, even in sleeping pillows. Gold hoard. It's almost a financial instinct. The more you worry, the more you buy gold. And in many periods of history, it's not wrong. When the currency crisis war, devaluation of the local currency occurs, gold has really played a role in preserving value. But in the context of modern finance, maybe we should calm down and ask a few questions. Frankly, is gold really absolutely safe? Whether it deserves to be the only shelter, or even the best. But gold doesn't make money. It's not profitable, it's not dividend paying. It doesn't bring in monthly income. You can only profit from gold by buying low, sell high. In other words, it's only worth it if you're patient and lucky enough. When money devalues and bank interest rates are almost zero and investors go to real estate stocks, crypto in search of quick profits, gold will be excluded because it is not as attractive. But when the currency tightening cycle starts, interest rate increases, another problem comes up: the opportunity cost. Let's imagine you have 500,000. Gold on one side is still glistening but unprofitable. On one side are government bonds, or saving at an interest rate of 8 to 9% per year. Which side would you choose? Many practical investors will choose a side with a steady cash flow, rather than hugging a piece of metal just to watch. Gold is not as stable as many people think. In fact, gold prices are still strongly influenced by macro factors like monetary policy, inflation, and especially the power of the dollar. These two properties have a strained relationship with each other. When the USD rises, gold usually falls and vice versa. So, if you buy gold based only on feelings, give peace of mind without tracking the world's economic landscape, then that peace of mind can be just an illusion. There have actually been gold prices decline when the market is surprised. For example, as US interest rate hikes sharply hands the dollar soared. Many investors are fleeing from gold to go back to cash or bonds. Gold prices plummeted in a short period of time. And if you're all in gold at the right time, what's called shelter can become a place where you get stuck. Gold should be kept. The answer is yes, but keep it right and in the right dosage. Gold should still be part of the asset class, but as an insurance, not the whole financial armor. The proper weight can be 5 to 10% of total investment assets. It depends on your risk appetite and long-term strategy. If you look at gold as a long-term companion, loyalty is not in a hurry. You'll see its value in the market. It's really chaotic. But if you expect gold to make you rich quickly, you can have 7 hopes, because gold is neither a stock nor a coin. And it doesn't run the rumor mill. Important thing is to understand correctly the role of gold in the overall financial picture. It's not an absolutely peaceful landing, but it's a solid pad. If the market suddenly shakes, and sometimes only part of the portfolio is in gold, you've got a safe enough breathing space to avoid too big a shock. So if you're thinking about buying gold for sure, ask yourself what you are buying for. Capital protection or running following the crowd, long hold or hope to surf? The answer will help you not to turn gold into a burden. Fifth property type, USD king currency or two-edged knife. When it comes to the world's most powerful currency, no name can beat the dollar. In the financial world, it's still called the king of currencies. And that's right. Most international trade transactions, live contract, cross-border payments, it's all tied to the US dollar. But what's interesting is that even a king has two sides. On the one hand power and on the other hand danger. When the US Federal Reserve raised interest rates, immediately the dollar rose sharply. For sale by smart capital money, it's always going somewhere that pays higher interest and safer. In such a period, we see global cash flows to the US. And as a result, in emerging markets like Vietnam, Thailand, Philippines, cash flow is withdrawn, exchange rates fluctuate, and inflation starts knocking on the door. You can see this clearly in the period from 2002 to 2020. As we allow rapid interest rate hikes to curb inflation in the US, the dollar is rising compared to most other currencies including VND. Many investors in the country rush to transfer money to United States dollars because I think this is a secure asset channel. Some are holding the dollar and waiting for the price to rise, hope to beat the exchange rate. Keep the dollar in the country. Seems to be a golden price strategy in the desert, sure and wise. But life is not that simple. The problem lies in the pivot of monetary policy. I feel like the US economy is cooling down. They can go from raising interest rates to lowering them. And what happens if the dollar starts to weaken? That's right, all the money you keep in dollars. It also started to lose value. Not many people hold the dollar until the exchange rate peaks, then wait a little longer. But sometimes that is the beginning of the day. USD is down, and the gross profit from the beginning turns into a net loss when selling. However, the greater damage is not in the small individuals, it's in the dollar business. Many businesses imports in Vietnam used to borrow USD because the foreign currency interest rate is lower than VND. But when the USD and VND exchange rates rise sharply, the cost of debt repayments skyrocketed. There are units that lose 10 billion in just one quarter. Debt does not increase, but only the exchange rate deviation that caused the financial statements to shift from profit to loss. This situation is not uncommon, and it's worth mentioning that exchange rate risk doesn't knock on the front door. It comes silently but extremely incisive. It's like a double-edged knife. Should you keep the dollar? The answer is maybe. but keep it with a clear target and a reasonable proportion. Don't mistake the dollar for an absolute shelter. It also fluctuates, and sometimes it moves very quickly. Instead of all in dollars, they believe that money always pays off. You should ask yourself, keep for what? Short-term or long-term, contingency or investment? There's a simple way to check. If you hold dollars and you open the exchange rate up every day, maybe you're not investing and you're worried. Zoom currency market. And always remember that the dollar is an asset that reflects economic power, but that power changes in cycles. When the US pumped the dollar weekly. When America squeezes money, USD strong as other countries recover faster. The money flows back. And all of those factors, it's out of your control. What you can control, it's how you allocate assets and limit your greed. Keep part of USD can help you diversify your portfolio. Value protection when the yen decreases. But the expectation that the dollar will always rise is an illusion, should not be kept long. In finance, what is strongest today? It may be the weakest point tomorrow, if you're not flexible. And the dollar, even the king of money, is not outside the rules. We just walked through it together. The panorama of 5 types of properties. Popular. Real estate, securities, crypto, gold, and USD. Names that were once considered saviors. It's a refuge in the eyes of many. But at this point, the money pump cycle is over. We're forced to see one thing. No property is completely immune. What distinguishes the survivor from the swept away? It's not the type of property they hold. It's at the readiness level. A's prepared in advance. Keep the initiative and discipline. He's the one who doesn't just get through the storm, but we can catch a new wave when the time comes. So, how to live, survive, and even rise in this period of instability? The first thing to remember: keep your capital alive before you think of profit. At a time when the market is shaking, the preservation of capital is more important than making a profit. Cash. Highly liquid assets such as physical gold, short-term bonds, will give you flexibility to manage. When an unexpected opportunity arises, don't all in. No matter how much you believe in housing, stocks, or coins, always give yourself a breath. Next is the old principle, but it's never outdated. Diversify properly. Diversification is not just about investment, it's about getting according to how much risk you take. Safe people should own most of the property, on stable channels. People with active cash flow, you can try the riskier market, but still in control. Don't put eggs in a basket, especially when that basket is on a boat. Look out. Another strategy. Sounds simple but hard to be patient. When the market crashed, the blood is still flowing. Now is not the time to get to the bottom. The market always has cycles. A downward wave will always reach its destination, but only for those who are awake enough to wait. Be rational enough not to jump into the unknown. And the most important thing is to only invest in what you know. Real estate has real value when there is a steady flow of rent, not when it's in a project hanging only live by advertising. The stock is only worth buying when the business has real cash flow. The real product is not just because it's going down. Crypto if you want to keep it. Choose a project with a clear application. There is a real community, and you're willing to take small risks. Crisis is not always bad. It's a psychological test. It takes away the panics, but it gives the sober a chance. And it's like the tide when the water recedes. You'll know who's swimming without clothes on. If you have the cash, you have the ability to make independent decisions. You still have a chance. If you've ever been confused, it doesn't matter. What matters is what you learn. And what are you going to do from this point forward? Act based on knowledge, not emotion. Let knowledge guide you. And let discipline keep you on track. Because in the financial markets, calmness is sometimes worth more than bravery. If you find this content helpful, don't forget to share it with your friends. interest in finance, and click subscribe so you don't miss the actual view. And deeper in the journey of personal wealth management. You want to be a panic, leaving the last party, or the sober person who pulled out his seat early. The decision is always yours.